In this video, I'm going to share with you an easy trading strategy that has allowed me to make on average $24,350 per month. But don't take my word for it. Here is a sneak peek of some of the incredible results that my exclusive members have achieved trading this exact system. This system is simple, fully mechanical, fully rules-based, and it takes all of the guesswork out of it. For those of you that are new here, my name's Liam and I've been trading, investing, and coaching within the financial markets for the last 8 years. In that time, I've helped hundreds and hundreds of traders get funded and become consistently profitable. And I studied mathematics and finance at Newcastle University. And that's why in this video, I really want to share with you everything that I've learned along the way. And so with that being said, let's dive into this video. Okay, so this is how I consistently make $24,350 per month on average, trading my simple, fully mechanical, rules-based trading system, which removes all of the guesswork out of trading. What I've done is I've broken this video down into two simple parts. Part one is where I'm going to show you the data and the logistics behind how I actually make this. And then part two, what I'm going to do is actually show you the exact trading system. And I've broken that strategy down into 4 simple steps. Okay, so first, how is this all possible, right? So the way that I've done this and the way that I've achieved this is through leveraging prop firm capital. So right here, you can see that I'm funded $800,000, okay? So this is $600,000 with FTMO, and this is $200,000 with Alpha Capital. So this is not my money. This is not my capital, but I am using these prop firm accounts, and I'm using these prop firms in order to leverage my capital. So what I want to do is head over here, right? And so in total, right, let's have a look at my total funding capital. So this is how it all kind of breaks down, right? So the $24,350 per month, this is how it all kind of is comprised, okay? So I'm funded a total of $800,000, right? And I'm not trading all of this funding capital in one single go. What I am doing is I'm trading a total of $500,000 of funding capital at one given time. So what I like to do, and kind of the rule of thumb that I follow, is I'm trading, around 50 to 60% of my total funding capital in one given go. So I'm not trading everything, and I don't really believe in trading everything as like a consolidated fund. And the reason why is very, very simple, right? Because it's really to do with diversification, right? If you trade everything together and, something catastrophic happens, then what is the end result, right? Well, you lose all of the funding capital. You're then back to square one, right? So for me, I like to essentially have like a buffer of funding capital. And so, I'm trading around 50 to 60%. This allows me to be slightly more diversified. And if something does happen, then at least I have funding capital, to still trade, right? And I wouldn't lose everything, okay? So this is what I'm trading in one go, okay? Then what this is comprised of is, the risk, right? What am I risking per trade? And I like to be pretty conservative. Like once I'm actually funded, I like to use 1% risk per trade, okay? So what this translates over to is essentially $5,000, okay? So per trade, I'm risking $5,000, okay, of prop firm capital. And the next thing is really like a very simple formula, okay? So what this is essentially how to calculate your average returns, okay? And so this very simple formula is comprised of something called risk. So this is just literally what we're risking per trade. And this is risk times your R multiple. And so what I'm going to do is write this. This is your return. And this is your return on a monthly basis, okay? So this is really, really simple. Basically work out, through your back testing data, your forward testing, your live testing, whatever you do, right? Work out what is your return and divide that by how many months that you've been backtesting, right? If you've done a year's data, whatever your total return is, you would just divide that by 12, right? So let's say your return is like around 60R, right? Divide this by 12, you've got your monthly return, okay? And so this follows on, right? So my risk per trade, so this is 5K, right? And my average return per month, okay, is 5R, okay? So I expect whatever my monthly return is, I'm then going to times this by 5K, okay? So on average, my expectation, you remember this is on average, right? My expectation is on average per month, I am expecting 25K, okay? So this is really important because remember, this is an average, okay? So this is not every month. Some months are going to be more, some months less. Some months you're going to have a losing month, right? But my point here is this is what you can expect. So we're building an expectation, and this is how you can expect to make this based on what you're risking and based on the amount of capital that you're actually trading. Okay, so it's the combination of prop firm capital and the amount of risk that we are placing per trade and the return. So imagine kind of like a triangle, right? A triangle where you have risk per trade, you have return, let's just put return as R as well, and you have the prop firms, okay? So we're leveraging these three things in order to be able to make this, okay? So, if one of these things is, goes missing, right? If we are not leveraging prop firms, well, then this doesn't work, right? If our system is not profitable, well, then this doesn't work, right? If we are super aggressive and we're not using consistent risk, right? So one trade we might risk, 15K, one trade we're scared and we risk 1K. Well, then this doesn't work, right? So it's the combination of these three variables that allows me to be able to do this on a consistent basis. And I don't mean consistent like every month because, as I've said, that's not the case. But I mean, based on the data, we can build a consistent expectation, okay, of what we can expect on average per month. So there's a huge difference, right? And so, yeah, this is how I break it down. This is how you can expect sort of what I can expect on an average month, right? So, yeah. Okay, so this is all well and good, right? But how am I actually sort of formulating this? How am I coming to this risk per month, right? So this is really important, right? And this is where we look at data. So this follows on very closely here. And this is what is really the pinnacle of every trader, right? So if you're a losing trader, if you're somebody that's struggling with trading, then this approach right here will transform your trading 100%, right? So let's break it all down. So we're looking at data of over 200 trades with my fully rules-based trading system, right? Remember, for every trade that is taken here, the rules are defined, it's fully mechanical, and there's no kind of guesswork, right? So it's really important to kind of keep that in the back of your mind, right? So what we have, right, we have the asset, we have the month, okay? So we have January all the way to December, right? So 12 months, super simple, right? You can see we have break-even months, green months, red months, really good months, whatever, right? The point is, what we're going to get here is a total at the end, right? What we have is we have trades, okay? What is the total number of trade per month? You can see here, right? 6 trades per month, 12 trades per month, etc. This is going to change, right? Well, sometimes people say, how many trades do you have per week, per month, or whatever? That's irrelevant, right? I place a trade when my rules line up. And so that's why some months you're going to have like, a lot more trades, some months maybe slightly less. And that's also to do with market conditions, right? So it's not always going to be favorable. And so, we're going to get onto this in a lot more detail, but we need to know when we're actually placing trades, making sure that the market conditions are favorable, okay? We have the wins. So, per month, how many wins, how many losses right here. And we have the strike rate, okay? Again, going to be very variable, right? Because this is an average. Some months, very high, right? Like you can see, 60% strike rate in the month of September. Some months slightly lower, right? 20% strike rate in March, 20% strike rate and still, like a minus 2% gain, minus 2% return, right? Not bad, right? Even with a very low strike rate. So yeah, really, really important to look at it on a data perspective. But the most important thing in terms of how this relates to this 5R per month on average, right, is this right here. It's this return, okay? So we have a 31% gain. Bearing in mind, this is using 1% risk per trade, okay? Nothing more, nothing less. This is consistent every trade, okay? We have the same for the other asset that we trade, which is the US 500, also known as ES. So the same exact data, right? Notice the consistency. Again, notice the percentage gain. So what do we have? We have another asset giving very good returns over 12 months of 30%, okay? So you can see here kind of like the distribution of returns, right? We have 11R in London, 19R in New York, right? So the distribution of returns is pretty even, slightly biased for New York, but the returns here are pretty quite general, right? We can see that the returns are coming from both sessions. Whereas when we look at gold here, the returns are very heavily distributed in the New York session. And so, I'm not going to kind of spell it out too simply for you, but you can start to make assumptions based off of the data here, right? Okay, so what have I found here? What have you kind of inferred here? Well, the inference is that the return is 61%, okay? Or you could, note this is 61R, okay? So whatever you're risking, that you're going to make 61 times your risk. And that's given that your risk is consistent per trade, okay? Next, how do we break this up? Well, simply, we divide this by 12, right? And this gives you an average return of about 5, give or take, but around 5R, right? So, okay, so this is how we get to the return per month on what you can expect on average per month, okay? So this is how it's kind of baked into the kind of strategy. And so this is how I get to the total of around $25,000 per month, because I'm risking 5K per trade. My average return per month is 5K. Super simple, times them together. This is what you can expect on average, okay? So I'm not going to go into this anymore. I feel like I've really hammered this home. And so this should be very clear for you now. Okay, cool. So just to summarize what you've learned here, right? This is how I consistently make on average $24,350 per month, okay? Trading a simple, fully mechanical rules-based trading system, leveraging prop firms, okay? Very, very important, right? We've understood kind of like the trifecta, right? The triangle of the variables involved, right? Risk, return, and prop firms. It's the combination of these three things that allow anybody to be successful trading prop firms. You've understood that if any one of these things is essentially neglected or not present, then the whole kind of process falls apart. Okay, so part one was amazing, but if you don't understand part number two, you will never be able to do this on a consistent basis. Okay, so I'm going to break down everything step by step. So this is the exact trading system that I personally use every single day in the markets. This is the exact system that has allowed me to get funded over $800,000. And this is the system that has allowed me to make consistently, on average, $24,350 per month. And it's also allowed hundreds and hundreds of our members that I've personally coached in order to actually get funded themselves and also to become consistently profitable as well. And so I've broken this down into 4 simple steps. And step number 1 is identifying daily directional bias. And all this simply means is, when you turn up to the market, are we looking for longs today or are we looking for shorts today? Because a huge problem that so many traders are facing is they're using very subjective ways to identify their daily directional bias. Like 1 minute they're long, 1 minute they're short, and they're kind of sporadically chopping and changing, right? So my approach to the market is very, very simple. And so what this directional bias does is it takes all of the guesswork out of it. And so what I want you to do is head over to the indicators tab at the top of your screen. And then I want you to apply this indicator right here. So it's the EMA 20, 50, 100, and 200. And this one is by Dr. Sweets. So click the indicator, add it to your chart. Then once it's applied to your chart, double click the indicator and you can remove the 20. So this top one right here, this is the 20 exponential moving average. We don't need that one, right? So uncheck this and you're left with a 50, 100, and 200 EMA. And this is what we use to identify our daily directional bias. Okay, so how do we do this, right? So the 50 is in green, the 100 is in blue, and the 200 is in red. Okay, so for example, when the 50 EMA is greater than the 100, which is greater than the 200, this indicates that we are long bias on this market, right? So this means that we are only looking for longs, right? We're not looking at shorts. We're not looking to stay out of the market. It just means, all right, our bias is bullish. We're looking for longs. There's nothing really more to that, right? We're not looking at taking trades directly off of the EMAs, but we're just using them as a kind of general filter, right? This is how we filter our market regime. And all that simply means is, are we bullish, bearish, or have no bias, right? So a regime, in particular, a market regime, just means, what is your stance on the market? Where do you think that the market is likely to go, right? Do you think that the market is likely to go higher, go sideways, or lower, right? And we can really make a decision, a very simple decision, right? Of that we expect this market to go higher. If you want to get more technical, then what you can look at is, our expectation is that the draw on liquidity is to the upside. And that's just really a complex way of saying that we expect higher prices in the market, and vice versa. Like, let's look at this period of price over here, right? This time, this is the complete opposite, right? The 50s on the bottom, 100s in the middle, 200s on the top. This indicates that we are sell bias on this market. So our daily directional bias is sell bias. And you can see, right, we ended up getting a continuation lower, right? And of course, we're going to look at entries and pinpointing entries in a moment. But the first thing, like the most crucial thing, is can you have a bias, right? So before you start overcomplicating it with, liquidity or, confirmations or whatever, the first thing that you need to do when you turn up is like, what is my bias, right? Like, what am I looking for, right? And if you can't do that objectively, if you can't do that simply, easily, and, something in a way that is quite low energy, then no wonder you're sort of failing as a trader, because this is essentially the foundations, right? The foundations to your system. Okay, so step 1 was amazing, but if you don't understand step number 2, you will never be able to time the market correctly. And so step number 2 is a session-based manipulation. Okay, so we're looking at gold on the 15-minute time frame. So bearing in mind, this strategy is a 1 time frame strategy, and my analysis, execution, and trading decisions are all based off the 15 minutes. Okay, and so I want you to understand that we have the Asia session from 7 p.m. until 12 o'clock midnight. Bearing in mind, this is Eastern time, so EST. We have the London session from 3 a.m. until 5 a.m. Eastern. And we have the New York session from 8 a.m. until 10:30 a.m. Eastern. And I want to make it very, very clear. So we're only looking at taking trades during these high volume sessions, okay? So this is during the London session. And this is during the New York session, right? So we're not looking at taking trades outside of these session windows, right? This is absolutely vital. So we're not bothered really what price is doing in between these sessions, right? We're certainly not executing between these sessions. And likewise in this kind of space right here. So we aren't executing during these windows outside of the kill zones, right? We're only executing during London, which is, between 3 and 5 a.m. Eastern, and New York between 8 and 10:30 a.m. Eastern. You may ask, well, why is that the case, right? Well, it's very, very simple, okay? So there's something called intraday seasonality, which just simply means, when is the market moving? Right? On average, of course, we're never going to be 100% right, okay? But on average, right, we get a lot of volume. We get a lot of volatility. And most of this is coming in during London, right? And most of this is coming in during New York, right? And in particular, right, because we're looking at session-based manipulation here. So if we are long buyers, right, like we are in this example, and just to recap why that is, right? 50, 100, and 200 EMA, they're in order, right? We're bullish, right? So until these cross over, so, because the 50 is the faster moving one, until these cross, we're bullish in this market, and we have no reason to kind of believe otherwise, right? So we're bullish in this market. What have we seen, right? This is where we look at session-based manipulation. So if we're bullish in the market, we want to see manipulation below a previous session's low, okay? So if we're bullish, we don't care about the session highs. We don't care about these session highs. Yes, maybe we can use them for targets or whatever, but in terms of actually entering a position, if we're bullish, we need to see manipulation below these sessions, right? So I don't personally trade gold in London, okay? So I'm not really bothered about this session here, but what I am bothered about is the New York session, right? So I'm just playing this on a little bit here to get to the start of New York, right? So this is the start of New York right here. This is 8 a.m. until 10:30 a.m. Eastern. However, what have we seen, right? We've seen a manipulation of the London session low. Okay, so I'm going to mark this on. This is the London low. And what have we seen, right? We've seen price come lower below the London low. Okay, so what does that tell us as a trader? Well, we know that there's a lot of stop losses resting below this London session low. So anybody that is long in this market, right? So any Asia traders, any traders from the London session, if they're getting long in this market, well, where are their stop losses going to be, right? Of course, we don't know exactly, but what I can tell you is majority of them will be below this London session low, right? So anybody that's trading intraday, their stop losses are going to be below here. And so what does this do to them? Well, this stops them out. This manipulates them out of their position. So that's what a session-based manipulation is doing. It's stopping out any early buyers who think that the market is going to go higher, right? This stops them out. So they're no longer long, right? Essentially, they're induced short because they have to get out of the long positions. So that forces them to sell at current market price. So if they're selling, this induces a lot of selling into the market, right? What does this also do? This induces a lot of breakout traders into the market. Why is that? Well, as soon as price closes below here, or even if it wicks below, it doesn't matter. This is going to induce traders short, thinking that the market is breaking, extremely lower, right? But they don't understand context. Because if we zoom out here, what is the context? Well, we know that the context is higher prices, right? Why is that? Well, price is moving from bottom left to top right. So just in terms of a general direction, context is higher. Context is, prices are more likely to move to the upside. So that's the context. However, traders are seeing this as a breakout to the downside. So they don't understand context. They don't understand essentially the bigger picture, right? So this is going to trap them short. Again, this is going to induce more short traders into this market, right? This is what provides the fuel for bigger players, institutions, people that need liquidity to move the market, right? Because they can't buy. If you're huge, if you're looking at executing a huge position, you can't buy when everybody else is buying. You need to wait for somebody on the other side of that trade. So when does that happen? Well, it happens right here. So we know buyers are stopped out. This forces them to sell. Also, breakout traders are induced short. So most traders are not long in this market right here. And I know that just based on, 8 years of experience, but also based on how traders think, how they behave, and really what's actually going on kind of deeper here. So yes, people see this as a pullback, right? But also when you understand why on kind of a granular level, it starts to make a lot more sense, right? And it starts, maybe the paradigm's already shifting where you're thinking, oh, right, the amount of times where I've got long in the market thinking it's going to go higher and it goes higher at the end of the day. But I was stopped out, I was manipulated out and then it went higher. And so that's why it's really important that we are aware of session-based manipulation, okay? So, if you're trading the London session, you want to see price manipulate Asia. So, for example, here, it didn't happen, right? But if you were trading this London session, you want to see London come lower before we go higher, right? Because this is going to induce traders, stop them out, etc., right? So whatever your bias is, you need to see traders stopped out, panicking on the wrong side of the market, right? That's what provides the fuel, okay? There's many ways to illustrate this, okay? But this is how I view it. And this is what works for me, okay? All right, perfect. So this is session-based manipulation, and this is what we have essentially seen here. And we quantify that by if we are bullish, okay, in summary, if we're bullish, we need to see price come below a previous session's low. So we're trading the New York session. What's the previous session? It's the London session. So we need to see that taken out. That's what this is doing right here. Okay, cool. Okay, step number 2 is amazing. But if you don't understand step number 3, you will never be able to actually pinpoint your entry. And so step number 3 is entry confirmation. And all this simply means is, what is our trigger to actually get long in this market? We know that we want to get long. We've seen the session-based manipulation. What is the trigger, right? We can't just get long, right? Because we don't then have a logical place to place a stop, right? So very, very simply, what we're waiting for, once we've seen the manipulation, is a 15-minute bullish candle closure during a New York kill zone. So during a kill zone, okay? So you can see here, this is the New York kill zone. And if we zoom in here, what have we got? We've got a 15-minute bullish candle, okay? This closed at 8:15 a.m. Eastern, okay? So during the kill zone, okay? So we're not entering at 8 a.m. We're waiting at least for the first 15-minute candle to close. Well, why is that? very simply, right? It's because at the first 15 minutes of sessions, we often get false moves, right? We often get fake moves, okay? And so this allows the market to settle. It allows the market to show its hand, and it allows the confirmation to actually occur during the kill zone. Another thing to note here is at the time, the exact time of confirmation, this is vital. This is vital. At the exact time of confirmation, which is here, 8:15 a.m. Eastern, we still have the EMAs in order, right? Yes, they're close together. It doesn't matter. The 50 is still above the 100, which is above the 200. That is enough for me to still take this trade. I don't care if they're bowing over. I don't care if they're flattening. What I care about is if they are in order, then I'm taking the position. Right. Okay, cool. So how do I enter this position? Really, really simple, right? I don't enter on the close, right? This is not a good way to enter because we don't know if this momentum is going to continue or if this momentum is going to stop, right? So a good way to do this, and what I always do, is I enter on the break of this 15-minute bullish candle high, okay? Enter on the break of the 15-minute bullish candle high. Why is that? Well, what that means is, we closed here. If we break the high, think about what's happening, right? Momentum is stepping in. We're making another higher high on the 15-minute time frame, okay? This is bullish price action. So just one 15-minute candle close for me is not enough to take a trade because I don't know at this stage if price is going to push higher and momentum is stepping in, or if this was just like a one candle pullback and we just drop lower, right? So this kind of helps to kind of filter that out. A lot of false entries you will filter by doing this. It also gives you time and makes you more patient, right? Because you just set a buy stop here on the break of this high, right? And then you're triggered, right? We're not getting crazy emotional on the closes or anything. It helps you be a lot more calm. Okay, so now you know how to pinpoint entries, but this doesn't really mean much unless you know actually where to have invalidations, targets, stop losses, etc. And so that's why step number 4 is the most vital, and that is take profit in stop loss placement. To be honest, I should probably phrase it as more stop loss placement and take profit, because stop loss placement is more important than where you're going to be taking profit. Because if you don't know where your invalidation is, then you don't really know much as a trader, right? So, okay, cool. We've established entries on the break of this high. So let me just look at this entry right here. And invalidation, where does this go? Really simple, guys, right? Invalidation goes below the liquidity sweep. And then what do we target? So the invalidation goes below the manipulation. So whether you call this a liquidity sweep, a liquidity raid, whatever, it doesn't really matter. It's all the same thing, okay? But the overarching kind of concept is this is your manipulation. So if this is your manipulation, your stop needs to go below the session-based manipulation, okay? Then what are we targeting? Well, it's really up to you, but I like to target a repeatable 1 to 2. So a 1 to 2 risk to reward. This is what I've done in all of my backtesting, all of my data. This is what I do every single day. Okay, we're not looking for a home run in the market. We're just looking for a small, repeatable, bite-sized piece that we can take on a consistent basis over and over again. Okay, so really important. We're not going for home runs, right? We're not going for daily highs. We're not going for 1 to 10s and crazy risk to rewards. And you will find that it happens. There's going to be trades where it happens, right? But what I've found is the optimal way for this system certainly is a 1 to 2, bank your profits, move on to the next trade, and then come back the next day, all right? This is also great for your trading psychology because you're not having huge drawdowns, right? Any systems where you're banking profits with repeatable risk to rewards, your drawdown is always less, right? Because you're not targeting higher or home runs, okay? So this also helps you become very calm. Okay, so I was triggered long in this trade right here. And just before anybody's thinking that I'm cherry picking this trade, here was the exact analysis that was sent ahead of time to my one-on-one students. And here is the exact execution of this trade. All right. So just for anybody that's doubting, worrying, or thinking that I'm cherry picking, which a lot of people do. So I get it for sure. Right. But that was my exact entry. And then it's just a case of allowing this trade to play out. Okay. And you can see, right, within sort of 45 minutes, this trade had hit take profit for a 1 to 2. And you're in and out of the market. All right. By 9 a.m. Eastern, you've banked your profit. You're essentially done for the day, pretty much. And you're free to do whatever you want. And let's play this on, right? Because I think it's really important, okay? So you can see we then got this major continuation higher, right? So we took profit at a 1 to 2, right? We manipulated London high, so we expect this to go. And we also have the Asia high, okay? So all of this got manipulated. This liquidity got ran, okay? And so, you know, you could easily look at this trade and be like, oh, this is a home run right here. This is a home run trade, right? So you could look at this and be like, well, you know, it happened here. So moving forward, well, I'm just going to target daily highs, right? That is not logical, right? What is logical is when we look at the data and we have a look at what is optimal. So I don't care what happened in one trade like this one. What I care about is over hundreds of trades. What was the optimal risk to reward? You know, where was the optimal stop loss placement? That is a lot more beneficial to me rather than just looking at a sample size of 1, you know, N equals 1, number of trades equals 1. This is not a significant amount of data in order to make a trading or a long-term decision. What is your data, your backtesting data, your forward testing data, and your years of track record. Right? So that is more important to me. And I think it should be a lot more important to you, right? So once you start adopting this shift that, you know, yes, this can happen where we get these home runs. Yes, this can happen. But that is not my strategy. That is not your strategy, or might not be your strategy, right? You know, so just kind of take like a zoomed out approach and just think like, that is not my strategy. You know, my strategy is to take this small piece where I know I have an edge, where I know I have a good strike rate on a consistent basis over years. That is my strategy. Going for a home run thinking, oh, this could be the one, that is not my strategy, right? So, you know, making that shift from somebody that, or if you are somebody that is emotional, is going for these home runs, is not really trading based on data or kind of quantitative data, then really kind of internalize this and take a step back and think, oh, maybe that's why I'm not succeeding, or maybe it's because my psychology took a hit because I was going for home runs, right? So it's definitely, you know, there's no clear answer, right? That is the point of this exercise, right? But it should start kind of provoking questions internally to you to where you can start making these decisions for yourself that are going to be beneficial, right? So this should start kind of shifting the paradigm for you. And so, yeah, this is the simple 4-step trading strategy that I trade every single day in the markets. This is what has allowed me to consistently make, on average, $24,350 per month. And this is the exact strategy that has allowed hundreds and hundreds of my members to also gain consistent profitability, funding, and everything else that comes with profitable long-term trading. So no, you're not going to get rich overnight with this. This is something that, you know, you need a long-term vision. You need to kind of have that approach to your trading. Otherwise, it's very, very hard to make it. If you would like to see me trade this live every single day in the markets, and you would like to learn the exact blueprint to this fully mechanical rules-based trading system, then make sure to check out my exclusive community or one-on-one mentorship. The link is in the description down below. Also, if you haven't already, then make sure to check out my free Discord community. The link is also in the description down below. As always, thank you so much for your time and support, and you take care, guys. Bye-bye.